Hey yo, what's up everybody? Good day to you all, ladies and gents. Welcome back to Matrix Investing, the #1 YouTube channel that is dedicated towards giving you education based off investing in capital markets. Now in this video, we're going to look at the book value per share, its usefulness and challenges to investors, as well as how we can use it on an actual company. Now if this is the very first time you're watching our videos, we advise you to check out our previous videos so that you can have a better understanding of what exactly we're teaching. If you also find this video useful, by all means, please like this video, subscribe to our channel, and hit that notification bell so that YouTube gets to notify you each time we get to upload videos into the platform. Now, with that said, ladies and gents, let's get down to business. So starting off by defining what the book value per share is. Now, this is a financial metric that is obtained after taking net assets of a company and subtracting it from the preference shareholders' capital. The difference that is obtained there is divided by the average number of common shares outstanding. So then the net assets is, in other words, shareholders' equity or book value per share. It's the same thing. Now, the shareholders' equity recorded by a business on its statement of financial position minus the value of preferred equity and represented on a per share basis. So that is what the book value per share is. Now, the reasons why we deduct off the preference shareholders' equity is because that amount of money has got nothing to do with the common shareholders, of which are the true owners of the business. So in the case that a business stops operating and investors are required to get back the capital they've invested, then they won't have any cut or any portion of the preferred equity, as it belongs only to preferred shareholders. So for more info about preferred and common shares, you can check out our video titled Everything About Investing in Shares. So the result that is shown here is the amount of capital that investors would get in the case that the business were forced to shut down. So in case your darling investment were ever to kick the bucket, the book value per share available is what you're entitled to get back, representing the capital you've invested. RIP business that this person invested in the stock market. So this value is also compared to the share price of an individual company in order to determine as to whether a business is overpriced or underpriced. Though in most cases, the share prices of individual companies, even excellent performing ones, are usually higher than the book value per share. So if the book value per share is greater than the market price, then that company is being sold at a very cheap price. It's underpriced. I mean, like, damn, the market price is smaller than the actual company of a business. So then that's a bargain to investors, and that's a bargain they would go for, as it is expected that eventually the share prices will rise to similar or greater heights than the book value per share. However, for the case that the market price is larger than the book value per share, well, that shouldn't come as a surprise, as even most of beautiful investments lying around have that scenario. So in case you encounter this, of which you'll most likely will, then there are other ways of figuring out the value of a business, some of which we'll show you all in future videos. Challenges behind using the book value per share. Challenge number one, it is not a very effective measure for finding intrinsic value of a company, as it only looks at what is available as equity in a company in comparison to market price, leaving aside other factors such as the company's growth rate. So basically, even though this is the easiest method of finding the intrinsic value of a company, it's still very ineffective, as it only looks at one perspective of a company and ignores out other perspectives such as the business's cash flow projections, growth rates, and etc. Therefore, as an investor, don't place your final decision on what a business's value is using the book value per share, especially if the market price is larger than it. However, for companies that do perform well and have a higher book value per share than the market price, then hey man, don't miss out on the opportunity. Go for it. Basically, what I'm saying is that the book value per share is only useful when it's larger than the market price, but for well-performing companies. So, challenge number two, businesses could hide some of its liabilities and therefore eventually causing the book value to look overstated. So then businesses can do some shady stuff, man, so that they can look sexy to investors. And one of the ways they could do that is by suppressing their liabilities, by showing less of it in the statement of financial position, hence as a result making the book value look larger. So to avoid this trap, look at the book value per share in a 10-year perspective. That way you can see if it had been growing well or weak. By weirdly, I mean 1 year it looks very, very down, and the next it's popping like Jay-Z, like crazy, high growth, all that stuff. So then by normal, well, it's growing at a sensible rate. So then don't forget to look at this in a 10-year time span. So then, ladies and gents, here's the formula. You take the shareholders' equity minus the preferred equity and divide that by the common shares outstanding. Then you should be able to get the book value per share of an individual company. So then by seeing this formula, let's go apply it on an actual company. So here we are, ladies and gents. For this example, we're going to use the Swissport Tanzania company as of the year 2019. Now remember, the main objective here is to calculate the book value per share. So we're just going to head on straight to the statement of financial position, and we should be able to get the book value, which is the same as total equity, as 30,910,000,000. Now, earlier in this video, we said that the total shareholders' equity is the same thing as the book value, and it's the same thing as the net assets. So explaining a bit further about net assets is basically the difference between the total assets and the total liabilities in a company. So to prove that, we could basically take the difference between the total assets that have been recorded in Swissport. We should take the total assets, which is 47,285,000,000, and deduct that from 16,375,000,000, which are the total liabilities, and we should be able to get the net assets, of which are 30,910,000,000. So then this figure right here is equal to this figure right here. So it's basically the same thing. Now our next step is to take what is ours and deduct what is not ours. And what is not ours is the preference shareholders' equity. So as of the total equity, going to the equity section, there isn't any sort of recordings for preferred equity. So then they haven't issued any sort of preferred shares. So then we're not going to deduct anything. We're just going to take that amount we got as is. And so our next step would be to divide that figure with the total number of common shares outstanding. Now, to get that data, I usually just go to the earnings per share, and we all know that it's attained by taking the profits divided by the total number of ordinary shares, of which the company indicates that the number of ordinary shares is 36 million. So this figure we got right here, we're just going to take that and divide that by 36 million, and we should be able to get 858.6111 as our book value per share for us common shareholders in Swissport Tanzania. So then our next step from here would be, say, to compare this amount of book value per share with the market price. So then the market price for Swissport as of yesterday, December 16th, was 1,180. By the way, the market still haven't closed. It's 11:14 a.m. in the morning. So I'm just going to take what they got yesterday. So then that's 1,180. And if we're to compare that with the book value we got, we can basically see that Swissport is sold at a higher price than the book value. However, as we told you, if this case were to happen, which you'll most likely get, it's in both good companies and bad companies. It's such a common thing. So then if this were to happen, basically just get along with it. Just be like, okay, fine. You could use another more effective way, and then the figure you get there, you can compare it with the market price and be like, okay, maybe this one's underpriced, or maybe this one's overpriced. Then you could also look at other aspects that show as to whether this company is a good company or not. So with that said, ladies and gents, thank you so much for watching this video to the very end. If this video has been useful to you, then we ask you to help us by hitting the thumbs up button, like the video, subscribe to our channel, and hit that notification bell so that YouTube gets to notify you each time we'll upload more videos like these into the platform. Share this video to your buddies. Sharing is caring and knowledge is power, so that they can also benefit from this video just like you. If you're also on other social media platforms, that is Instagram, Facebook, and Twitter, don't forget to check us out there. Our account name is Matrix Investing. The links to our social media accounts are in the description below. We provide content related to investing in Tanzanian capital markets on a daily basis. So don't forget to follow, like, share, and comment. If you also have questions or opinions to contribute, you can do so in the comment section below or DM us on our social media accounts. We're only a DM away. So then anyways, ladies and gents, thank you all so much and have a great day.